Welcome to the Wednesday edition of Tech Stocks Daily, where we're serving up a platter of tech stock thrills hotter than a freshly booted up laptop. Today we've got CrowdStrike sending waves with a jaw-dropping stock nosedive thanks to gloomy future guidance despite their stellar past quarter. AppLovin's is spicing things up with a swirl of drama involving options market buzz and a $900 million business shuffle. Meanwhile, Google is charging ahead with strategic alliances and antitrust skirmishes guaranteed to keep your ears perked. To top it off, Baidu is rocking the value hunter scene, leading the sector growth race like a champ. Stick around because we've got all this and more bubbling under the surface, waiting to unfold. Let's dive into the roller coaster ride that is today's tech stock landscape. All right, folks, grab your favorite caffeinated beverage and get ready to dive into the thrilling world of cybersecurity. Because today's headline act is none other than CrowdStrike. This cybersecurity juggernaut has been all over the headlines today, and not necessarily for reasons they'd want to invite investors over to a cocktail party for. Let's kick things off by talking the numbers game. CrowdStrike's stock took quite the tumble, dropping by as much as 12% at one point today before somewhat stabilizing with a drop of around 6.34%. And the blame game here, it's not what you think, because their recent quarterly performance exceeded Wall Street expectations. Yep, you heard it right. In Q4, CrowdStrike posted adjusted earnings of €1.03 per share on a revenue stream of $1.06 billion. Wall Street analysts were expecting less, around 86 cents per share on revenues of $1.04 billion. So what gives? Well, this is the stark reality of Wall Street, my friends. The magic word we're looking for here is guidance, and not the kind you get in high school when you can't decide whether to take up drama or basketball. Investors were spooked by CrowdStrike's forward-looking guidance, which isn't exactly painting a picture of rainbows and unicorns. The company's projected earnings and sales didn't meet the lofty expectations piled up by optimistic analysts. They're forecasting a sales range between $4.744 billion and $4.805 billion, and investors were hoping for numbers a tad higher. Even juicier, they're expecting earnings per share to be a bit light on the wallet, coming in far below what was on Wall Street's wish list. Adding fuel to the fire, CrowdStrike is still dealing with the aftermath of a global IT outage from July last year. You know, the kind where you can't check Netflix or your favorite meme account? That crisis resulted in customers' devices facing operational hiccups, days on end of them in some cases. CrowdStrike expects the fiscal first quarter earnings to fare poorly, projecting numbers well below analyst consensus. The outage resulted in some additional costly apple pie slices on their balance sheet, with incident-related expenses and tax expenses tied to acquisitions, adding more grits to the meal. Operating losses in the company's fiscal 2025 Q4 climbed to $85 million compared to a tidy $30 million operating income the previous year. Add to this a plunge in margins and elevated sales and marketing expenses, and you've got investors scratching their heads wondering if this growth is coming at a steak dinner kind of price. They are spending more, but their revenue growth is not as spicy as it once was, and Wall Street doesn't have the appetite for that. CEO George Kurtz is painting a comeback story for CrowdStrike, hoping that their stick-to-itiveness with clients and their singular platform excellence can deliver. With ambitions like reaching a $10 billion annual recurring revenue, he might just have a few rabbits to pull out of those executive sleeves. So there you have it. CrowdStrike is anything but dull today. The glamorous world of tech stocks, where one minute you're everyone's favorite banquet toast and the next you're the subject of annoying Thanksgiving table gossip. Will they bounce back? Only time, perseverance, and maybe a little bit of cybersecurity wizardry will tell. Oh, the tech world is buzzing today, and the spotlight is on AppLovin. If you haven't heard, AppLovin has been riding a roller coaster of juicy news tidbits. Think of it as the tech world's version of a cinematic thriller, with financial drama, business mystery, and a protagonist trying to navigate stormy weather. First off, there's significant movement in the options market related to AppLovin, catching the eye of metaphorical financial whales, who think AppLovin might just be the catch of the day. Over half of these investors are bullish, throwing down serious dough with call options suggesting a price range between $295 and $400. This activity hints that these big players are betting on positive movement, contrasting with the recent bearish vibes that have infiltrated parts of the market discourse. Why bearish vibes, you ask? Well, AppLovin has found itself embroiled in a contretemps with short sellers who have lobbed some pretty serious accusations its way. Reports by outlets like The Bear Cave, Fuzzy Panda Research, and Culper Research allege everything from ad fraud to quasi-illicit data manipulations, reminiscent of a plot twist involving stolen technology from Meta. In textbook corporate drama, these reports have knocked the stock price down a peg, creating tension between short sellers and bullish supporters. AppLovin's leadership aren't twiddling thumbs over this drama. CEO Adam Foroughi and an array of Wall Street analysts equipped with pixel swords and spreadsheets leaped to the company's defense, fiercely rebutting the accusations and suggesting that expectations of their demise are largely exaggerated. Now turn the page because this novel gets even better. Lovin is reportedly offloading its games unit to Triple Dot Studios for $900 million. Consider this a strategic chess move amidst an otherwise chaotic board. Known for its mobile gaming acumen, is slated to gain control after the purchase, perhaps allowing AppLovin to place more chips on their core focuses. Furthermore, the legal eagles have flown in, with the law firm Wolf Haldenstein Adler Freeman and Herds LLP launching an investigation into whether AppLovin has danced over any legal lines in its recent dealings, especially concerning shareholder interests and potential securities laws violations. So, where does that leave retail investors and anyone with a stake in the game? Right now, it's a sit-tight situation. With such mixed signals and peculiarly volatile news, the advice from analysts and experts is to tread cautiously, closely monitoring the atmosphere. This isn't just your average snapshot moment in tech. It's a fluid, evolving story with major consequences for all players involved. Keep your eyes peeled, friends. The AppLovin saga has all the makings of a tech page-turner. Oh boy, folks, Google's been making quite the racket in the headlines today, and I've got the scoop for you. Let's start with Google's strategic alliance with Carrier Global to disrupt the energy management game. Picture this: Carrier teaming up with Google Cloud to bring some serious AI muscle to your home. They're working on supercharging Carrier's battery-powered HVAC systems with Google's analytical saber, aiming to unveil smart energy solutions. This partnership means homeowners will get to save more green when those utility bills come knocking. With Carrier's home energy management system frolicking in the playground of Google's AI, we're looking at smarter ways to handle grid congestion while your AC's purring like a content cat during peak energy crunches. I mean, who wouldn't want to optimize HVAC operations and keep those costs from blowing through the roof? Next, we dive into the grand AI smartphone spectacle in China. Chinese smartphone brands have rolled out their shiny new toys at MWC 2025, and guess who's holding their hands? None other than Google's Gemini AI. From eliminating photobombers to making AI assistants your personal reservation maestros, these smartphones are stepping up with Google's feature flair. It's all part of a bigger move to jab at the dominant noses of Apple and Samsung. Teaming up with a mighty ally like Google is a bold, strategic dance by brands like Xiaomi, Oppo, and Honor, especially now that Honor's pouring $10 billion into AI advancements like it's AI soup for the techie soul. Now on to the heavyweight fight. Google's duking it out with Uncle Sam over some rather intense antitrust cases. The DOJ is cracking down on Google's dominance in search and advertising, with the DOJ suggesting sell Chrome and say sayonara to cozy search engine agreements. Google's argument? A potential breakup will do more harm than good, potentially impacting national security and economy. With a final ruling set for next August, it'll be fascinating to see where this tech tug-of-war swings. As Google navigates internal shakeups, staff cuts, and AI investments, the courtroom drama opens new discussions about tech industry dominance and regulation. Finally, over in Australia, there's a dust-up over YouTube being left off the naughty list of social media bans for those under 16. Meta, TikTok, and Snapchat are all side-eyeing this call, questioning why YouTube gets a hall pass while they're grounded. The Aussie government says YouTube's got its gold star for being educational, but rivals ain't buying it, pointing fingers at those same algorithms present on every platform. There you have it, a whirlwind tour of Google's gristmill of news today. Whether they're innovating on home heating and cooling or squaring off against antitrust flames, it's clear that wherever the tech wind blows, Google is right there, making waves and proving its weight in silicon. Stay tuned, because when it comes to Google, the plot's always thickening. Today in tech news, Baidu has been stealing the spotlight with an impressive triple feature. Strap in as we dive deeper into why this Chinese tech giant is making waves. First up, it's all about Baidu's smackdown against HealthStream in the world of value stocks. For all the value hunters out there, Baidu has shown it's got some serious game. Graded as top dog with a value grade of A by the Zacks Style Score system, Baidu has been flaunting some impressive valuation metrics. Its forward PE ratio, the almighty PEG ratio, and the thrifty PB ratio are all giving investors something to cheer about. While HealthStream isn't doing too shabby, Baidu stands out with its attractive figures in these classic investor favorite metrics. When you're looking to snag a stock that won't break the bank, BIDU looks more like a primetime bargain compared to its rival, HealthStream, which is still holding its own with some flashy numbers. In our second chapter of stock excitement, Baidu is once again proving to be a shining star in the Zacks rank system. This baby is all about focusing on that sweet spot, earnings estimates and revisions. Anyone rocking a Zacks rank number 2 and a value grade of A demands attention. What's drawing in extra investor gazes is Baidu's notable PE ratio, and particularly its turbocharged PCF ratio. Baidu's cash flow status outshines its industry, making it look likely that this stock is cruising under the radar and priced lower than it ought to be. So for those looking to invest based on solid fundamentals and cash outlook that's blinging gold, Baidu seems the current crowd favorite. And for our final act, Baidu shows off its stellar growth compared to its fellow computer and technology comrades. Over the past year, Baidu has seen a 3.4% rise, yes, amidst the backdrop of an average dip of 5.8% for the whole sector. It's not just about Baidu's color-by-number data and pretty figures. It's about an improved earning vision that's driving this upbeat investor sentiment. Despite a year of market shifts and data-shaking events, Baidu shows it's not just keeping pace, but winning the race. So there you have it. Baidu, a triple threat stock dominating attention today with superior value rankings, hot growth figures, and outright sector performance muscle. What are your thoughts? Do you think Baidu warrants such investor trust, or do you see other opportunities lurking in the shadows? We'd love to hear your take, so drop a comment and join the conversation. Who knows, your insights could set the stage for our next big segment. All right, folks, if I had to pick one stock to explore further from today's buzzing tech report, let's go with CrowdStrike. It's a name that's taken quite the nosedive today, despite reporting Wall Street beating quarterly performance. Definitely a roller coaster worthy of our focus. Now, given the situation, CrowdStrike stock is having a bit of a public relations crisis, not because of poor past performance, but due to guidance that's setting off more alarm bells than a malfunctioning smoke detector. The earnings smacked expectations right out of the park, but it's their future outlook that's got investors doing the nervous nail-bite routine. Should we buy, sell, or hold? If you're currently holding, you might want to stick it out a bit, considering the company reported solid earnings and has a well-regarded position in the cybersecurity domain, a space that's inherently primed for growth. CrowdStrike's forward guidance and current market woes could present a potential buy-the-dip opportunity for risk-takers who believe the company will rally back on its long-term prospects. But they are projecting some headwinds, particularly relating to their fiscal future, which means more conservative investors might wait it out for stability before considering stepping in. For those without a stake yet, and you're tempted by the discounted pricing today, consider it a cautiously optimistic buy. Essentially, you're hedging on the company recovering from its short-term hiccups and sticking its landing in the cybersecurity market. Remember though, CrowdStrike still faces elevated sales and marketing expenses alongside the rebuilding from the IT outages, so due diligence here is paramount. So in my 2 cents, this one's a hold if you're in it already, but potentially a short-term buy if you're a believer looking into those cloudy future projections for a sunnier, longer-term reward. But hey, even superstar stocks have valleys in between those peaks. As always though, make sure to do your own homework, folks. Research thoroughly, weigh your risk tolerance, and maybe even consult some more expert opinions, because the last thing you want is to act hastily and end up needing emotional support from your portfolio manager. Keep learning, keep questioning. All right, tech enthusiasts, what a whirlwind of a day we've had on the NASDAQ. CrowdStrike is making waves with its unexpected stumble due to future guidance jitters, while AppLovin's is stirring up drama over options market maneuvers and strategic spins. Google's in the spotlight, from fueling energy management innovation to wrestling with antitrust fire, and Baidu's pulling off a triple feature by excelling in value and growth metrics amidst sector turbulence. If you found today's roundup as entertaining as I did, don't forget to smash that like button and subscribe for more tech-tastic updates. Share this video with anyone who loves a good stock shakeup, like the ones we've seen today. Remember, tomorrow we'll be back with even more riveting tech tales and juicy market jives. Until then, stay curious and keep those market vibes rolling.